right now, the global freight market is trapped in this really grueling 15-quarter recession.
Yeah, it is brutal out there right now.
It really is. I mean, the pie is shrinking, underlying carrier costs are just catching fire, and competitors are actively bleeding out.
Which makes what we're talking about today so crazy.
Exactly. Because somehow, sitting right in the exact center of this economic crater, one logistics company just posted a 20% jump in operating profits.
Defying gravity. That's really the only way to frame it.
Right. So today on the Deep Dive, we are applying our Talk Ticker's analytical lens to C.H. Robinson, ticker symbol CHRW.
And specifically, we're looking at their second quarter 2026 earnings call.
Yeah, we've got the full transcript, the management presentation, the analyst Q&A, all of it. Our mission today is to just, cut through all that corporate jargon for you.
Deliver the actual data points that matter.
Yep, and give you an actionable, highly opinionated bottom line on how on earth this company is pulling this off.
Because when you look at the fundamental inputs of their business for this quarter, the output, it just shouldn't be mathematically possible.
Right, like the math does not math.
It really doesn't. We are talking about a heavily saturated, hyper-competitive, third-party logistics market.
Where margins are usually razor thin, even when the economy's booming.
Exactly. So to see a 20% spike in operating income, while the rest of the industry is still, desperately searching for a bottom, it requires a structural deviation from how a traditional freight broker operates.
Well, let's ground this in the actual data, because I want to pull up the Talk Ticker's scoreboard for Q2 2026.
Let's hear it.
Okay, so total revenues increased 19.3% year over year.
A massive jump.
Huge. And adjusted gross profit, which is a really crucial metric for them, and we will get into why in a second, that increased 6.5%. Right. And then you have that adjusted operating income just spiking by 20%.
Which is the headline grabber.
Totally. Plus, their North American Surface Transportation segment, NAST, expanded its operating margin to a massive 40.9%.
That's a 280 basis point expansion, which is wild.
Yeah, and then Global Forwarding expanded its operating margin to 33.4%, up 470 basis points.
But the broader context around those figures, I think, is what actually makes them remarkable.
Oh, for sure. Tell them about the Cass Index.
Right. So while C.H. Robinson is reporting these huge margin expansions, the Cass Freight Shipment Index, which for those who don't know, is basically the ultimate barometer for North American freight volumes, that was actually down 3.3% year over year for the quarter.
Meaning the physical volume of goods moving through the entire economy is contracting.
Exactly. Fewer pallets are being loaded onto fewer trucks, period.
So the total addressable market for the quarter was actually shrinking.
Precisely. And in that shrinking market, C.H. Robinson's total NAST volume grew by 1.5%.
Wow.
Yeah, they didn't just tread water. They actively took market share from competitors in a declining environment.
And they outperformed the index for, the 13th consecutive quarter?
Yep, 13th in a row.
I want to pause on that dynamic for a second, because for anyone listening who, follows traditional retail or manufacturing, this just doesn't track.
It sounds like fiction.
It does. I mean, think about it. If you run a retail chain and mall foot traffic drops by 3%, you don't magically grow your revenue by 19%.
Let alone your bottom line profit by 20%.
Exactly. Unless you are fundamentally changing the nature of your business. But C.H. Robinson isn't a trucking company in the asset-heavy sense.
Right. They don't own fleets of trucks.
They are a broker. They literally just sit between the shipper and the carrier. So how are they extracting 20% more profit out of a contracting market?
Well, the mechanism lies in the difference between total revenue and what they call adjusted gross profit, or AGP.
Break that down for us.
Okay, so when a shipper pays C.H. Robinson, let's say, $1 million to move 1,000 loads of freight, that entire $1 million hits the top line as total revenue. But C.H. Robinson then has to turn around and actually pay the truck drivers, the rail operators, the ocean carriers to execute the physical movement.
Right. They have to buy the actual transportation.
Exactly. And whatever capital is left over after they pay those external transportation costs, that is their adjusted gross profit. It's their true net revenue.
Okay, so the AGP is what they actually have available to pay their internal staff, run their servers, keep the lights on, and, eventually return to shareholders.
That is the crucial distinction. So looking at Q2, their total revenue jumped 19.3%, but their AGP only rose 6.5%.
Meaning the cost of purchasing transportation went up significantly for them.
It did. But the critical data point here, the one that really indicates a structural shift, is that their adjusted operating income jumped 20%.
Which is wild. A 6.5% increase in gross profit translated into a 20% increase in operating profit.
Exactly.
That implies just an intense, almost absurd degree of operating leverage.
It really does.
Because if gross profit only goes up a fraction, but the bottom line explodes, it means the incremental cost of generating that next dollar of revenue is approaching zero.
It is the defining feature of this quarter, honestly. Damon Lee, their chief financial officer, explicitly quantified this in the transcript.
What did he say?
He stated that in Q2, the company achieved a 96% incremental operating margin.
Wait, 96%?
Yeah.
That sounds almost too good to be true. You're saying for every new dollar of gross profit they brought in, 96 cents fell straight to the bottom line as operating income.
The math holds up based on the financials they provided. They have somehow managed to hold their internal operating expenses completely static.
Or even reduce them.
Exactly. While processing higher volumes.
Which is not how this usually works.
Not at all. In a traditional freight brokerage model, revenue growth is highly correlated with headcount growth.
Right. If you want to broker 10% more freight, historically you had to hire 10% more human brokers.
Exactly. More people to sit in a cubicle, answer emails, negotiate with truck drivers on the phone, manually track shipments.
Just grinding it out.
Right. And those personnel expenses would rise in lockstep with the gross profit, perpetually suppressing their operating margins.
So they have fundamentally decoupled volume growth from headcount growth.
That's the secret sauce.
But I have to push back here a little bit. As an analyst, when I see a 96% incremental margin, my alarm bells start ringing.
Oh, absolutely.
Yeah.
It usually involves aggressive cost cutting.
Exactly. Cost cutting that can sometimes permanently damage the core business. If they are just slashing headcount to juice the quarterly numbers, they might be sacrificing customer service or long-term operational stability.
That's a very fair point.
Are we sure this isn't just a strategy of shrinking to greatness?
The skepticism is completely warranted, especially in an industry built on, relationships and human problem solving. But the transcript suggests they aren't achieving this through just blind attrition.
Okay, so how are they doing it?
They're navigating what the industry refers to as the squeeze. And how they survived the squeeze in Q2 is the real story behind that operating leverage.
Ah, the squeeze. Management spent a significant amount of time discussing spot market dynamics on this call.
They had to. It was the defining headwind.
Let's look at the actual mechanics of the freight market that caused this pressure, because I think it completely recontextualizes that 96% margin figure.
Yeah, let's break it down. So the freight market essentially operates on two parallel tracks, the contract market and the spot market.
Right.
Large enterprise shippers, think major retailers, automotive manufacturers, CPG companies, they prioritize predictability above all else.
They can't have wild swings in their budget.
Exactly. So they approach C.H. Robinson and negotiate annual or multi-year contracts. They establish a fixed, locked-in rate to move a specific volume of goods across specific lanes.
Like moving auto parts from Detroit to Atlanta for $2 a mile, guaranteed for the next 12 months.
Exactly. They want budget certainty for their supply chain. They can't have the cost of shipping their goods fluctuating every single day based on the weather.
Right. So C.H. Robinson takes on that pricing risk.
Yes, they agree to the fixed contract price. But when it actually comes time to move the freight, say on a random Tuesday afternoon, they have to source a truck from the highly volatile, real-time spot market.
And the spot market is totally driven by immediate supply and demand, right?
100%. If a massive storm hits the Southeast or if produce season kicks off in California, the local supply of available trucks just evaporates.
And spot rates skyrocket instantly.
Exactly.
Which means C.H. Robinson is essentially operating as a massive continent-wide market maker.
That's a great way to put it.
They're taking long positions on corporate contracts and then trying to cover those obligations daily in the spot market.
Hoping they can buy truck capacity for less than the fixed price they promised the shipper.
Right. But in Q2 of 2026, the supply side of that equation just violently inverted.
It was severe. Michael Castagnetto, the president of NAST, detailed this on the call. He said that truckload line haul costs per mile, which is their internal cost to buy capacity on the spot market, spiked by 29% year over year.
A 29% spike. That is insane.
And he further noted that dry van spot rates are currently forecasted to increase 34% for the full year.
So a nearly 30% spike in your primary cost of goods sold, But earlier we established that the overall volume of freight in the market, the Cass Index, was actually down.
Right, it contracted.
So why would the cost of hiring a truck jump nearly 30% if there is literally less freight to move? That seems so economically counterintuitive.
It does, but Castaneda attributed this rapid inflation to severe capacity constriction.
Meaning the trucks just vanished.
Pretty much. He specifically cited aggressive regulatory enforcement actions, like the Commercial Vehicle Safety Alliance's Road Check Week, combined with just natural market attrition.
Right, because we are 15 quarters into a recession.
Exactly. Thousands of small trucking companies and independent owner-operators have simply gone bankrupt, or they parked their trucks because they just couldn't survive the sustained low rates of the past 3 years.
The capacity has literally evaporated from the market.
So when you pull that much supply out of the system, the remaining trucks hold all the pricing power.
I see.
Even with depressed overall demand, the sudden lack of available vehicles causes the spot rate to jump.
So if we take that market maker analogy further, this is like a high-frequency trading desk that has sold long-term options at a fixed premium.
Right.
But suddenly, the underlying asset experienced a massive volatility spike. The cost to cover their position jumps 30% overnight.
That's exactly what happened.
And in the legacy brokerage model, this is where companies just bleed out. Their contract revenues are capped, their internal costs surge by 30%, and their margins instantly collapse into negative territory.
Historically, that is exactly the pattern. Brokers get caught in the squeeze during a spot rate inflection, and they get crushed.
But that did not happen to C.H. Robinson in Q2.
No, it didn't. Despite an internal cost spike of 29%, and despite the fact that 70% of their portfolios weighted toward those fixed price contracts, they held the line.
Management reported that their truckload adjusted gross profit per shipment remained entirely flat year over year.
Which is just, it's unbelievable.
Flat doesn't sound like a victory until you realize the alternative was a catastrophic loss.
Exactly. Absorbing a 30% cost increase while keeping your gross profit per unit completely stable is mathematically astounding.
Even Castaneda admitted on the call that this outcome is, quote, different than what we've been able to accomplish during historical spot rate inflections.
Yeah, they are explicitly acknowledging that in past cycles, this exact scenario would have just crushed them.
Which brings us back to my skepticism about the 96% incremental margins and the headcount reductions.
Right.
How did they hold margins flat in a 30% cost spike? The answer they provided is this proprietary operational strategy they've branded as Lean AI. It sounds like the kind of Silicon Valley buzzword that companies throw into earnings transcripts just to appease algorithmic traders.
Oh, totally. Like, we do AI now, please buy our stock.
Exactly. But given the financial results, it's clearly functioning as way more than just corporate marketing.
The transcript details some really fascinating mechanics regarding how they actually deployed this technology.
Yeah, Arun Rajan, their chief strategy and innovation officer, he had some really revealing comments.
He emphasized that this is not just a matter of purchasing off-the-shelf software licenses from Microsoft or whatever.
Right.
C.H. Robinson employs 450 in-house engineers and data scientists. They are physically building and owning their own application layer.
450 engineers at a freight brokerage.
Yeah. And they have constructed what Rajan called the world's first closed-loop agentic logistics system.
A closed-loop agentic system. Let's break down what that actually means on the ground for you listening.
It's best to compare it to the old way of doing things.
Okay, let's contrast how a load of freight was booked 2 years ago versus how it is booked today under this new system.
So if we look at the legacy process, the quote-to-cash lifecycle was just intensely manual and highly fragmented.
Very human-heavy.
Completely. A shipper emails a request to move, say, copper wire from Chicago to Dallas. A human broker reads the email, opens a historical pricing database, tries to gauge current market conditions, and manually types out a quote.
And then the shipper accepts it.
Right. Then the broker manually types that load information into a digital load board to advertise it to carriers.
And then the phones start ringing.
Constantly. A dispatcher for a trucking company calls the broker. They haggle over the rate. The human broker makes a judgment call on the margin, assigns the truck, and dispatches the driver.
It sounds exhausting.
And that's just the booking. Then for the next 3 days, that human broker is making check calls to the driver to ensure the freight is moving on time.
Oh, literally calling them like, where are you?
Literally. And if the truck breaks down, the broker has to manually intervene, find a replacement truck, notify the shipper, and recalculate the margin.
And then at the end, I'm guessing humans process the physical paperwork and generate the invoice.
Yep. It is a process entirely bottlenecked by human speed, human emotion, and human error.
So what C.H. Robinson has done is deploy hundreds of highly specialized, custom-built AI agents to systematically replace these micro tasks.
They are not just using AI to summarize emails. They're using it to actually execute decisions.
Which is a huge leap.
Rajan explained that they have developed a lean AI engineer capable of assessing a customer's entire supply chain network in 25 to 30 minutes.
To identify routing and pricing improvements.
Exactly. And historically, that same analysis took a team of human analysts up to 4 weeks to complete.
Compressing a 4-week analytical cycle into 30 minutes? That completely changes the velocity of their sales and pricing strategy.
It's a game changer. That lean AI engineer then feeds optimized parameters into a lean AI planner, which orchestrates the actual shipments by coordinating a whole swarm of secondary AI agents.
Wow. So these agents handle the quoting, the digital negotiation via API integrations with load boards, the automated tracking, and the exception management.
I love it.
Connecting this back to the spot market squeeze we talked about, this technological architecture completely explains how they survived that 30% cost spike.
Exactly.
Because if a human broker is trying to manually price a contract based on yesterday's data, they are going to get absolutely slaughtered by the spot market volatility.
They can't react fast enough.
Right. But an AI agent processing millions of data points across the entire North American freight network in real time, it can dynamically adjust internal pricing algorithms minute by minute.
It can instantly recognize that capacity in Atlanta is tightening, for example, and refuse to bid on low-margin freight in that specific lane.
Which protects the company from taking a loss.
It provides them with microscopic precision regarding price and cost discovery. The AI doesn't panic. It doesn't guess.
It strictly adheres to the margin parameters.
This brings us right back to the productivity metric that validates that massive headcount reduction you were worried about.
Let's hear it.
CEO Dave Bozeman stated that since the end of 2022, they have achieved productivity improvements, and this is measured strictly as shipments processed per person per day of over 60%.
A 60% increase in raw human output.
And CFO Damon Lee confirmed the resulting financial impact. In Q2, their average headcount was actually down 10.8% year over year.
They removed nearly 11% of their workforce, yet they processed 1.5% more volume in a shrinking market.
Generated 19% more revenue.
And expanded their operating profit by 20%.
The AI agents are absorbing all the frictional transactional labor. This allows a much smaller, leaner workforce to focus strictly on complex problem solving and client strategy.
That completely answers my earlier skepticism. They aren't shrinking to greatness or burning out their staff.
Not at all.
They have fundamentally altered the unit economics of a freight transaction. The cost of routing a truck has been permanently lowered through this digitization.
And Rajan noted that they put strict guardrails around the AI using their lean operating model. The AI isn't hallucinating freight rates.
Right, it's not going rogue.
No, it is operating within rigid, mathematically optimized parameters derived from decades of real-world logistics data.
So we have a really clear narrative here of operational triumph. They used custom AI to insulate themselves from a brutal supply-side cost spike, resulting in massive margin expansion.
A huge win.
But if the earnings call ended there, it would be a flawless quarter. As we comb through the transcript, though, there is a very dark, very serious legal issue that management had to address extensively.
Yeah, we have to talk about it.
We cannot analyze this company's future without discussing the legal liability environment they are currently operating in.
You are referring to the nuclear verdict in Texas.
Yes.
This represents a systemic risk, not just for C.H. Robinson, but for the entire third-party logistics model.
Absolutely. So for you, the listener, we are going to dive into the legal arguments exactly as they were presented by management on this call.
We want to be very objective here.
Right. We are just exploring the facts and the legal theories they discussed because they have profound implications for the company's balance sheet.
According to the CEO, an advisory verdict was issued by a jury in Texas against C.H. Robinson regarding a fatal trucking accident.
Bozeman addressed it directly. He acknowledged the tragic loss of life, of course, but management was absolutely vehement in their position that C.H. Robinson should not be held liable for the accident.
The legal theory at the center of these cases is crucial to understand. Plaintiffs typically argue a concept akin to vicarious liability or negligent hiring.
Okay, unpack that.
The argument suggests that the broker, because they possess deeper pockets and facilitate the transaction, bears responsibility for the actions of the independent carrier they select.
But Bozeman dismantled that premise from the company's perspective by laying out a very specific set of facts.
It was very clear.
First, he stated unequivocally that the carrier involved was an independent motor carrier. The driver worked for that independent company, not C.H. Robinson.
Right. Bozeman said, C.H. Robinson does not employ or control drivers. He did not communicate with C.H. Robinson, and we did not supervise, direct, or control his actions.
So they are establishing a strict legal firewall there. They act as a marketplace, connecting demand with supply, but they do not execute the physical service.
Exactly.
And the second, and perhaps most legally significant point, relates to how they vet the carriers they hire in the first place.
This is key. Bozeman pointed out that when C.H. Robinson dispatched this specific load, the carrier held the highest possible safety rating from the Federal Motor Carrier Safety Administration.
The FMCSA.
Right, which is the federal regulatory body governing commercial motor vehicles.
So from a defense standpoint, the argument is that the broker relied on the ultimate federal authority regarding safety.
If the federal government certifies a carrier as safe to operate on public highways, a broker should theoretically be protected when hiring them.
Exactly. And Bozeman added that this specific carrier had safely delivered nearly 270 loads for C.H. Robinson's customers prior to this incident without any issue.
He also noted that even after a federal review following this specific accident, the carrier still maintained that top safety rating.
Wow. So the conflict arises when state juries override that federal reliance.
That's the friction point. The implication of a nuclear verdict, which, is industry terminology for a jury award that vastly exceeds standard insurance limits, often driven by emotional factors, is that a broker is inherently liable simply by virtue of having a strong balance sheet.
And Bozeman explicitly called this out on the call. He said, a carrier only having $1 million in insurance doesn't make a brokerage company with a strong balance sheet liable.
Management stated they strongly disagree with the advisory verdict. They believe it was not based on the law, and they will immediately appeal if it is entered as a final judgment.
They expressed high confidence that they and their insurance carriers will be successful on appeal.
But management also used this incident to highlight a broader existential threat to the American supply chain.
Yeah, because if nuclear verdicts become the standard precedent, the risk profile of moving freight fundamentally changes for everyone.
Bozeman warned that if brokers are held strictly liable for the actions of independent, federally certified carriers, the cost of transportation in the United States will just skyrocket.
Service levels will degrade, and the movement of goods will be substantially constrained.
He made a direct appeal for Congress and the federal government to establish clear accountability standards across the industry.
He's essentially asking for federal preemption over these state-level jury decisions.
It is a massive systemic risk. But from an investment analysis perspective, we have to look at how C.H. Robinson protects itself compared to its competitors.
Right. If this chaotic legal environment is just the new reality of the logistics business, how does a company survive it?
This is where the transcript took a really fascinating turn for me.
Oh, totally. Instead of just playing defense, Bozeman and Damon Lee pivoted and used this massive legal threat as a way to highlight their competitive moat.
They essentially argued that their sheer size and financial fortress make them one of the only companies capable of navigating this environment.
They completely weaponized their balance sheet.
They really did.
Bozeman stated, events like this also reinforce why scale and financial strength matter. Customers and carriers rely on and benefit from providers like C.H. Robinson that have the resources and financial stability to manage complex legal and regulatory environments.
CFO Damon Lee provided the structural details on how they insulate that balance sheet. He noted that their insurance stack has historically been constructed more like an asset-based trucking company rather than a traditional asset-light broker.
Meaning they carry significantly deeper layers of liability insurance coverage than a typical 3PL.
Precisely. The typical mid-sized freight broker might carry, a few $1 million in liability coverage.
And if they get hit with a nuclear verdict,
they simply declare bankruptcy and dissolve the company.
Game over.
But C.H. Robinson has built an insurance fortress designed to absorb these massive shocks without disrupting their core operations or liquidity.
Lee did acknowledge that insurance costs for the entire industry are going to inflate dramatically as a result of these verdicts.
But he argued that C.H. Robinson is infinitely better positioned to absorb that headwind because they are starting from a foundation of prudent, high-level coverage.
The subtext here is just so aggressive.
Oh, it is.
While smaller competitors get wiped out by legal fees or skyrocketing insurance premiums, C.H. Robinson will sorely absorb the costs, leverage their lean AI to maintain margins, and take the market share left behind by bankrupt competitors.
It is a ruthless but highly effective corporate strategy. They are turning a systemic industry liability into a barrier to entry that protects their market dominance.
So, synthesizing this, we have a company navigating a 29% internal cost spike on the spot market, aggressively implementing custom AI to permanently reduce their transactional labor costs, and relying on a massive balance sheet to weather an incredibly hostile legal environment.
That is a lot of headwinds.
And through all of that, they still printed a 20% jump in operating profit.
It's remarkable.
Given that extreme stress test, how is management forecasting the rest of the year?
Well, the management guidance section of the transcript is where we see if this Q2 performance was just an anomaly or the establishment of a new higher baseline.
Let's hit the guidance data. For the full year 2026, they maintained their operating income target of $964 million to $1.04 billion.
Okay.
They narrowed their SG&A selling, general, and administrative expenses to a range of $540 to $580 million.
Got it.
And they lowered their expected capital expenditures, or CapEx, to a range of $65 to $75 million.
Now, on the surface, maintaining a previous operating income target might seem unexciting. Wall Street usually wants to see those targets revised upward.
Right.
But in the context of the macro environment we've just discussed, maintaining that target is an incredible flex of operational control.
Unpack that for us. Why is holding the line a flex in this scenario?
Because the foundational assumptions of that target have completely deteriorated since they set it.
What do you mean?
When Damon Lee originally set that $964 million operating income target at the beginning of the year, he noted that the financial models assumed the overall freight market volume would grow by 0 to 5% in 2026.
So they built their budget assuming a flat or slightly recovering market.
Right. But we now have half a year of actual data. The Cass Freight Shipment Index was down 4.7% in the first half of the year.
The market is demonstrably contracting.
Exactly. The pie is roughly 3 to 4% smaller than they projected, yet they are still committing to hitting the exact same profit targets.
That is fascinating. If the revenue pool is significantly smaller than projected and underlying spot costs are up 30%, how do you mathematically arrive at the same absolute profit number?
Damon Lee revealed the answer on the call. He stated that the company essentially found $40 million in internal self-help initiatives that did not exist in their original budget when they entered the year.
Self-help initiatives. Corporate finance terminology can be so opaque.
Very.
What exactly does $40 million of self-help look like in practice?
It basically represents the accelerated success of their lean AI implementation.
Oh, I see.
It is the realization of that 60% productivity gain. It means they were able to optimize their real estate footprint, rationalize their software expenditures, and reduce their headcount by 11% without sacrificing volume.
So they manufactured $40 million of pure margin internally to offset the macro headwinds.
Exactly. They didn't need the economy to bail them out. They engineered their own profitability.
But again, my skeptical brain kicks in here.
Go for it.
If they are lowering their capital expenditure budget to $65 million, slashing headcount, and wringing out $40 million in internal savings, are they just hoarding cash to hit a target?
It's a valid concern.
Because if they underinvest in the business now, they will get crushed when the market eventually turns around.
To determine if they are starving the business or genuinely optimizing it, we really have to examine their capital allocation strategy.
Right.
Where is the free cash flow actually being deployed?
Well, the transcript data provides a very clear answer, and it suggests they are absolutely playing offense.
Let's hear the numbers.
In Q2, C.H. Robinson returned a staggering $301.3 million to shareholders.
Wow.
Yeah. That represents an 88% increase year over year in capital returns, right in the middle of a freight recession.
An 88% increase in shareholder returns while your competitors are struggling to maintain liquidity is a massive signal of executive confidence.
It breaks down to $226 million in share repurchases and $75.3 million in dividends.
By deploying $226 million to buy back their own stock, the board and the executive team are signaling that they believe the market is severely undervaluing their new AI-driven operating model.
Stock buybacks are definitely a classic indicator of internal confidence, but they also allocated significant capital toward external growth.
Yes, they didn't just buy their own stock.
They allocated $79 million of capital for acquisitions in Q2. And they specifically highlighted the acquisition of a company called Desperate Logistics.
Putting aside the unique name, the strategic rationale behind buying Desperate Logistics right now is highly revealing.
Damon Lee described Desperate Logistics as a company bringing, quote, differentiated expertise in premium transportation solutions for high-value freight.
Right.
He explicitly stated that this fits their M&A strategy of acquiring niche tuck-in companies that have incredible capabilities but yet are underscaled.
Let's analyze what high-value freight means in this context.
Please do.
This isn't pallets of paper towels or bottled water.
Yeah.
This is highly sensitive electronics, pharmaceuticals, aerospace components.
Commodities that require extreme security, temperature control, and specialized handling.
Exactly. And because the liability and the complexity are so much higher, the margins on high-value freight are vastly superior to standard dry van shipping.
So they identified a smaller competitor that possessed a highly profitable specialized capability, but lacked the capital and the network to scale it nationally.
Spot on. In a down market, valuations for these smaller, underskilled companies become very attractive.
So C.H. Robinson acquires them at a reasonable multiple.
Plugs that premium service offering into their massive global network.
And immediately layers their lean AI architecture over the newly acquired operations to strip out redundant manual costs.
It is an instant injection of high-margin revenue that they can scale infinitely across their existing customer base.
The capital allocation data firmly refutes the idea that they are shrinking to greatness. They are aggressively buying back undervalued equity, maintaining a strong dividend, and executing strategic high-margin acquisitions.
Which brings us to the ultimate question of our Talk Tickers format.
Yes, it does. We have dissected the 20% profit jump, the mechanics of the spot market squeeze, the granular details of their closed-loop AI agents, the defensive posture of their balance sheet against nuclear verdicts, and their aggressive capital allocation.
That's a lot of ground covered.
So what is the bottom line? As an analyst looking at this mountain of data, what is your definitive opinion on the signal this quarter sends to the market?
My opinion is that this earnings call represents a fiercely bullish signal. The overarching narrative here is that C.H. Robinson just survived and thrived within a multivariable extreme stress test.
A stress test that would have historically broken their operating model.
Without question. If you are evaluating a company, you learn very little when the macroeconomic winds are at their back.
Anyone can steer a ship in calm waters.
Exactly. You want to see how the architecture holds up when the system experiences maximum pressure.
Right.
C.H. Robinson is operating at the absolute bottom of a 15-quarter freight recession. They absorbed a sudden, violent 29% spike in their core spot market costs.
And they are navigating an unpredictable, highly litigious legal environment.
And despite all of those converging headwinds, they outgrew the market index, expanded operating margins by hundreds of basis points across multiple segments, and dropped 20% more profit to the bottom line while reducing their headcount by 11%.
Which leads directly to the actionable takeaway for anyone listening who is analyzing this stock. The concept of the coiled spring.
The coiled spring.
Explain the mechanics of that future upside for us.
Well, the freight market is inherently cyclical. The bullwhip effect from the pandemic caused a massive inventory glut, which triggered this 15-quarter recession.
Right. Everyone ordered too much stuff, and now they don't need trucks to move it.
Exactly.
Yeah.
But eventually, inventories will deplete, consumer demand will normalize, and the Cass Freight Index will turn positive. The market will grow again.
And when it does, C.H. Robinson is attacking that growth with a completely different cost structure.
That is the core thesis. By utilizing lean AI to digitize the manual friction of the brokerage process, they have achieved mid-cycle operating margins in the deepest trough of the market.
They proved they can generate a 96% incremental operating margin.
Which means the operating leverage they possess is coiled tightly.
Because when the freight volume comes flooding back into the system, they won't need to embark on a massive hiring spree to handle the transactions.
No, they won't.
The AI agents don't require overtime pay, they don't take weekends off, and they scale instantly.
Exactly. The AI infrastructure will process the surge in digital transactions, and because their fixed costs are heavily controlled, the vast majority of every new gross profit dollar will drop directly to the bottom line.
They have successfully lowered their operational floor, which means their future margin ceiling is now exponentially higher.
It is just a masterclass in utilizing a downturn to permanently restructure unit economics.
We started this deep dive exploring a paradox, how a logistics company could defy financial gravity in a shrinking market. But after tearing down the data, it isn't a paradox at all.
No, it's just the ruthless, highly digitized evolution of the third-party logistics model.
It is a textbook example of technological execution overriding macroeconomic headwinds. Which leaves me with one final provocative thought for you, the listener, as we wrap up this analysis.
Let's hear it.
It's something that became glaringly obvious as we detailed the impact of those 450 in-house engineers. The broader market has been entirely conditioned to believe that the AI revolution is confined to Silicon Valley.
Oh, absolutely.
We look for the AI boom in software as a service companies, mega cap tech conglomerates, and generative chatbots that can write code or generate images.
We view it through a purely digital lens.
Precisely. But C.H. Robinson's Q2 performance suggests something entirely different. It suggests that the most lucrative, immediate, and tangible return on investment for artificial intelligence might actually be hiding in gritty, physical, legacy industries.
The blue-collar application of AI.
Think about the mechanics we just discussed. If custom-built, closed-loop AI agents can compress a 4-week analytical cycle into 30 minutes, dynamically price freight contracts during a 30% cost spike, and squeeze 60% more raw productivity out of the chaotic process of routing physical trucks on American highways, are investors completely overlooking the industrial supply chain?
It certainly implies that the true winners of the AI boom may not be the companies inventing the foundational models, but the legacy companies that figure out how to successfully operationalize those models to solve complex physical problems.
Exactly. While the market is obsessed with chatbots, C.H. Robinson is using AI to literally move the physical economy, fundamentally altering their margin profile and pocketing a 20% profit jump to prove it. The macro environment might be in a recession, but the company with the best algorithms is still extracting massive value.
That's the real takeaway here.
Thank you for joining us on this deep dive. We will catch you next time as we continue to translate the jargon, follow the data, and uncover the real mechanics driving corporate performance. Stay curious.